We briefly talked about how is GDP calculated, right? But we said that we'll not go in too much detail because all the calculation part of the GDP is part of A2 economics. So when we move to A2, we'll obviously discuss about those issues, right? So then after that, we talked about how do we compare GDP between countries, right? So if you remember, I did tell you that GDP is either you can compare GDP between countries just by looking at which country has more GDP value, or there are two better indicators to compare, to compare countries in terms of their overall economic growth and prosperity. So one is GDP growth rate, which basically simply calculates how fast the country's GDP is growing. Growth rate like 5%, 10% would show that what is the percentage increase in the country's GDP. And another way to compare uh, country's progress is through GDP per capita. What is GDP per capita? GDP per capita is average income. And how do we know? How do we calculate the average income? So we just divide the GDP of a country with its population, and that gives us GDP per capita, right? So students, that is something that we have already discussed. Then in the last class, we talked about that how is GDP determined, right? Now, quick recap, right? So we are doing unit 4, which is macroeconomy, and macroeconomy or macroeconomics deals with issues that are related to entire economy, entire country, not just one product or one sector. Then the next thing that we said was that what is GDP, right? So it is total value of all goods and services produced in an economy, right? So from 1st January 2022 till 31st December 2022, whatever will be produced in Pakistan, that would be part of Pakistan's 2022 GDP. Yes or no, right? So that is the total value of all goods and services produced. And why is it important for us to calculate GDP? So the answer to that question is that it calculates national income. So GDP calculates the total income of all the people who are living in a country, right? Yes or no? But then we said that GDP is not a very good indicator to compare countries' performance. Why? Because GDP, being the total production of a country, would obviously be most probably, not obviously, most probably that would be higher for countries which have more, which have bigger size, bigger countries with more resources, more population. Not always, but more likely that bigger countries will have more GDP, right? So what are two better statistics to compare performance between countries? So one is GDP growth rate, like how fast the country is growing. Like 10% increase means that compared to last year, this year, the country had 10% increase in its total production value. 10% increase in its total production value, or in other words, you can say that there was 10% increase in the total income of all the people who are living in that country, right? That is what GDP growth rate calculates. And then another statistic that you can use to compare performance between countries is GDP per capita. Divide the GDP with the population, that gives you GDP per capita. Okay, now in the last class and what we'll do in today's class, right? So we said that GDP is determined through the intersection of aggregate demand and aggregate supply. We already know what is aggregate demand and what is aggregate supply. So the way we show macroeconomic equilibrium on a graph is through intersection of aggregate demand and aggregate supply. So you have general price level on the y-axis, you have real GDP on the x-axis. What is aggregate demand? Aggregate demand is the total demand for all goods and services produced in an economy during certain time period at different general price levels. I repeat, aggregate demand is the total demand for all goods and services produced in an economy during certain time period at different general price levels, right? So if you remember in the last class, we had quite detailed discussion as to what aggregate demand is. In fact, in today's class as well, we'll discuss more about it. And upward sloping is your aggregate supply. What is aggregate supply? Aggregate supply is the total production. Aggregate supply is the total production of all goods and services produced in an economy during certain time period at different general price level. Total production of all goods and services in a country during certain time period at different general price levels, right? Now, just like market demand and market supply, just like market demand is downward sloping, inverse relationship between price and demand, similarly, aggregate demand is also downward sloping. And we will talk more about it in today's class, that why is aggregate demand downward sloping, right? But what you need to know for now, that if general price level if general price level will be higher, right? So let's say if initially the economy is operating on point A and then it moves to point B, right? So at higher general price level, your aggregate demand was low. At low general price level, your aggregate demand is high. Easy? Is everyone clear on this? We good on this, right? Okay, but in today's class, we'll discuss more about this. Okay, and aggregates supply is upward sloping. More the price level, more the production, because that means more profit for the producers, right? Okay, great. Now, wherever the two intersect, aggregate demand and aggregate supply, that is macroeconomic equilibrium. This graph is known as macroeconomic equilibrium. That will show us what will be the general price level and what will be the level of real GDP. Easy? We good on this? Okay. Now, students, have a look at this. What we'll talk about in today's class. Okay. Components of aggregate demand and factors that affect each of these components. I repeat. So we already know that there are 5 components of aggregate demand. And in today's class, we need to discuss what factors affect these components. Why? Why is that important? We'll see in a bit, right? So first thing that you need to know, that aggregate demand is made up of consumption, total investment of the country, total government spending, plus exports minus imports. Why are we subtracting imports? Can any one of you tell me why imports is coming with a negative sign? Any guess? Aggregate demand is subtracting imports. Why are we subtracting imports? Okay, now let me tell you the reason for that. So imports are being subtracted because to calculate bills of payments expensive, because they're not really, Zohan. No, not to calculate BOP. BOP is a different thing. That's a different thing. Have a look at this. I said aggregate demand is the total demand for all goods and services produced in an economy. So any good that is produced outside the country is not part of that country's aggregate demand, because it's not the demand for local goods. Are you getting me or not? So if I sit here and I buy something from Amazon, right, or I import something from another country, that is import. That would not be part of Pakistan's aggregate demand, because it's not the demand for local goods. It's the demand for foreign goods. Yes or no? Are you getting me or not? Because if we want to see that how much will be the total production, then we need to see that how much is people demanding for local goods. How much are people demanding local goods? Not just foreign, no, not foreign goods. Is it making sense, students? And how much is available? Are you getting me? So how much is the demand for your economy goods? How much is the production for goods and services in your country? Wherever those two intersect, how much is the total output in the country for goods and services? How much is the demand for those goods and services that are produced in your country? That is where the GDP of a country would be. Easy, good on this, right? That's why we subtract imports from this. We good? Can we move on? Okay. Now the next thing that we'll talk about, right, is factors affecting components of aggregate demand. Why is that important? Now I'll tell you why. Until unless we don't know what factors affect these components, we don't know what will affect aggregate demand. I repeat. So what is aggregate demand made up of? It is made up of 5 components that we just saw, right? Now, next, what we are about to do is to look at factors that affect these components. Why? Because once we identify what factors affect these components, only then we will be able to identify that what things affect aggregate demand. Is it making sense? Right? Okay, now let's talk about consumption first, right? So what factors do you think would affect consumption, right? We did talk about this quickly, right? So for this, right, we said one factor that affect income. Exactly, right? So income is one factor that affects consumption, right? So higher income means, so I'll write a positive sign, right? So there's a direct relationship, which means higher income, higher consumption, right? Then you have income tax. Income tax comes with a negative sign. I mean, it's just a way I'm writing this down. I mean, just to, kind of make things easier for you. But when you're writing on an exam, obviously, you can't write like this. You can't put a positive sign because it's not explaining itself, right? You have to explain in words. So what I mean by positive sign, that higher income means higher consumption. And income tax with the negative sign means higher income tax means lower consumption. Okay, what else? Right? Expectations about future, right? So if you're optimistic, in what sense? Now, COVID, one wave goes, another wave comes in, right? And that is why a lot of people are holding back their consumption, right? So people are holding back their consumption. Why? Because they're afraid that what will happen next and so on and so forth, right? So expectations about future is another thing that affects consumption. So if you're positive about future expectations that in future the economy will boom, you will have more incomes, you will be able to spend more, then your consumption would be higher, and vice versa, your consumption would be lower. Easy? We good on this, right? Okay. Expectations about future. What else, right? So these are some major things. Interest rates, yeah. So higher interest rate means that it will be difficult for you to borrow from a bank, and therefore you will borrow less and your consumption would be lower. Is it making sense, students? Is this simple, right? So these are some major factors that affect consumption, but obviously there could be few others which we are, right now we're not listing those. Okay, now as far as investment is concerned, right, investment depends on things like, right, first thing, interest rates. A lot of businesses in every part of the world, they don't, they do have their own money, their own capital, right? So it's not that business owners don't contribute anything, they do bring their finance. But when a business really becomes huge and it starts expanding, it needs more finance to expand and all that, right? Then most businesses go to a bank to borrow loans, right? To take loans. And then their main decision, their main factor that they are considering to decide whether to take a loan or not is the interest rates that the bank has to offer, right? So if interest rates are higher, you will borrow less. When interest rates are lower, you will borrow more, right? Then again, in this case, again, expectations about the future are important, or expectations about the economy. Students, now think about this. If, as I was giving you this example, that COVID has disrupted normal lifestyle, people don't know when will this end and so on and so forth. After every few months there's a new wave, people start dying, government has to spend so much money on vaccination, monitoring, blah blah blah. Things are not working, businesses are not working as they used to, right? Now, expectations about future, right? So expectations about future, right, means that if you're optimistic that in future economy will grow, businesses will boom, Pakistan will have more economic growth, then it will be a direct relationship. Otherwise, it will be an inverse relationship, right? Expectations about future, right? Okay. What else? What else? Right? Then I said another thing, political and economic stability. Why is this important, right? So if you think of foreign investment, right? Foreigners will invest, or foreign businesses will invest in your country given it is stable, right? So if it's stable, then they're more likely to invest in your business, because obviously, right, invest in your business in your country overall, right? Because they are sure that their investment won't be lost and things like that, right? But if economy is not doing that great, and there's political instability, right, instability, then obviously foreign investment will not come. Okay, then moving on to government spending. Now this is interesting, students, think about this. Government, okay, one thing I want to highlight before we move on, Zohan, you said in the last class, right, that speculation could also be affected. Okay, now let me tell you that what investment we are looking at over here is it's direct investment, right? So let me give you a quick recap again what we discussed in the last class. Direct investment is investment directly into the businesses. Now, what do we mean by that? Think of a BMW opening a production plant in Pakistan, or opening up their showroom in Pakistan. Similarly, another foreign restaurant, or not only just the foreign restaurants, right, or also some local brands, right? So let's say a new restaurant opening up in Pakistan, a new business opening up in Pakistan, right? The portfolio investment that you talked about, right, that is just money moving from one place to another, right? So as far as the portfolio investment is concerned, right? Like investing in stock exchange, investing in, cryptocurrency, investment in government bonds, investment in, come on, government bonds, investment, putting your money, investing in, other financial assets, right? So all of those are portfolio investment, right? So it is just forex, exactly, right? So all of these are portfolio investment. It's not into a real business, as we say, or not something tangible, right? Tangible, right? Which is providing a good or a service, right? So this portfolio investment is not what we're looking at, right? So speculation point, which you mentioned, is related to portfolio investment. Yes, that does affect portfolio investment, because if today people start anticipating that in future dollar will go up, so what will people do? People will start buying more dollars. They'll start selling other currencies like rupees and so on and so forth, and then start buying dollars, right? So that's how it affects. Okay, we good on this, students? Any confusion so far? Okay, so that's why I did not write speculation over here, right? Easy, good, great. Okay, perfect. Now, government spending. Now, this is an important thing about this. Government spending, obviously, one factor that will affect government spending is the tax revenue. How much taxes government is collecting in any period, that will directly affect government's ability to spend. So if you receive more revenue, more taxes, then you will have, the government has more ability to spend, more finances. If vice versa, less tax revenue, then obviously government won't be able to spend a lot. Okay, what else? Then another thing that directly affects government spending in an economy is its political and economic objective, right? Now think about this. So not always government is thinking from economic point of view. Um, so sometimes the spending of a government is also political. What do I mean political? Right? Now, governments know that next year, after 5 years, after a certain duration, they will be contesting elections again in the country. And for them to really claim people's vote, they need to show how much development they have and how many projects and how much development they have undertaken and all that, right? So when they do feel that there is more pressure for them to, do some massive projects and to, build public transport and things like that, which PMLN, one of the political parties, students who are from Pakistan would know, did was to show all these things. Yes or no? Right? Right, it could be biased, definitely. Definitely biased investment also means that, now this is very interesting. I mean, when you go on study economics at a later, at a higher levels, you will see that government spending is a more motivated through political objectives and political, you know, incentives rather than economic incentives, right? So for instance, since education and healthcare are not, the return on education and healthcare is not very evident. What do I mean? Not evident. Think about this. If today Pakistan decides that it needs to improve its public education, they will need to do so many, they will have to take care of so many things like, proper government, proper buildings of public schools, availability of teachers. Teachers are paid well so that they teach their students well, and accessibility to public schools, like every area, every backward area or region of Pakistan should have good public schools and all that, right? So are you getting me how many different things they have to take care of? But it will only be after a couple of years, it will only be after a couple of years that investment result or return on that investment will be inevitable, will be evident, sorry, when, these people graduate, they go to other countries for work or for higher studies, they innovate, they start new businesses, they become more innovative and productive labor force. Yes or no? Is it making sense? Right. So if there is no democracy, then things could even be more, bad in the sense, because think about this, at least in democracy, there is pressure on political parties to, what should be the word, to prove themselves or to, result oriented, mindset. If there is no democracy, if there's monarchy, like, rulership or something like that, then, I mean, sometimes things are really good, or dictatorship, sometimes things are really good. I'm not saying it's not, but sometimes it could be really messed up. Government spending is mostly on welfare, so they don't expect any profits. Yeah, but still, I mean, they have to, Zohan, they have to get votes. So if they are spending so much money and that's not even helping them to get more votes in the upcoming elections, are you getting me right? So that's something that they would be concerned about, and instead they will mainly focus on things that are more apparent, things that can get them more votes. So building a public transport is perhaps more popular decision, more politically sensible move compared to spending money on education and healthcare, because it will be after a couple of years that these people get good jobs and these people start working and start building companies and so on and so forth, that the result will be the benefit will be evident, right? Yes or no? Got it? Okay. So the two main factors that affect government spending is tax revenue and political and economic objectives, which we can't really say how will that go. But obviously, if there is a political incentive to spend more, then the government will spend more. If there is a political incentive to spend less, save more money, then they will be spending less and saving more money, right? Okay, now the next in line we have exports. So what factors affect exports? Any idea? What factors, what variables do you think would affect exports of a country? So the first one is very, exactly exchange rate, right? So if your exchange rate is strong, by the way, just a quick question, we haven't studied this yet, but if exchange rate is strong, would that help in more exports, less exports? If your exchange rate is stronger, right, less exports, exactly. Very good. So higher exchange rate or stronger exchange rate means lesser exports. Why? Because think about this, students. Think about this. So if you look at this like this, we'll talk obviously more about it when we move to the exchange rate part in unit 4. If let's say current exchange rate is $1 equals 100 rupees, and in future, the exchange rate between Pakistan and US dollars turns out to be this. So you're moving from this to this. So first question I'll ask you is that which of the two currencies became stronger, right? So from $1 equals 100 rupees to $1 equals 50 rupees, which of the two currencies became stronger? Can you tell? Rupee became stronger. Exactly. Very good, Krizat. Why? Because now you need lesser units. Now you need lesser units of rupees to buy $1. Previously, you needed more units of rupees to buy $1. Very good. Excellent, right? Now, coming back to the point, how will that decrease Pakistan's exports? So when exchange rate is going up, that's what we're discussing, right? When exchange rate of your country goes up, the demand for your exports go down. So why is that so? That is what I'm about to explain, right? Previously, an American an American used to give $1 and buy goods worth 100 rupees in Pakistan. Give $1 and buy, because $1 used to be equal to 100 rupees. So previously, an American used to give $1 and buy goods worth 100 rupees in Pakistan. Now, against $1, that American only gets to buy goods worth 50 rupees, right? Yes or no? So that's why our products are now more expensive for Americans, and therefore they will buy less. They will demand less. Yes or no? Got it? So stronger exchange rate, negative sign. Why? Stronger exchange rate means lower exports. Okay. Then another thing that affects obviously your exports is basically quality, how much quality products you're producing, variety, right? If you produce more variety of goods, there will be more demand for your exports, right? Competition, if you have a lot of competition in the market for the products that you produce. So if Pakistan produces textile, and textile is also produced by India, China, Bangladesh, Vietnam, blah blah blah, then there is high chance that our exports will be lower because there is so much competition in the market. But if Pakistan is producing something that's very unique, or other countries don't produce that much, let's say, I don't know, sports equipment, let's say, then our exports are likely to be higher in sports equipment because there isn't much competition. Yes or no, right? And then when you reverse all of these variables, you will get the factors that affect imports, right? For instance, simple, right? So when your exchange rate is stronger, your imports will be more. Why? Because it will be cheaper for you to borrow, sorry, cheaper for you to import, right? Now, sticking to the same example we were looking at over here. So previously you had to give 100 rupees to buy good worth $1 in America. Previously, Pakistanis had to give, um, you know, 100 rupees to buy a good worth $1 in America. Now, when our currency became stronger, when rupee became stronger, we only need to give 50 rupees to buy a good worth $1 in America. Yes or no? Is this making sense, right? So imports, exchange rates, right? So stronger the exchange rate, more the demand for imports. And then obviously quality. How good is the quality of imports, right? How much is the variety of the products, right? How limited variety. So if you have limited variety of local goods, then your imports will be limited variety of local goods. So if there's limited variety of local goods, the demand for your imports will be higher. Limited variety of um, local goods, right? Then you will goods, then you will import more and vice versa. Easy? This is making sense, right? Prices of raw materials. Can you explain this a bit? So we're saying prices of raw materials are increasing, and if we are importing the raw material or what? Zohan, I did not get you. So yeah. Okay, now this being said, students, what we'll do next is we will discuss. Now we are coming to the main part, that what factors affect aggregate demand. Now the idea is fairly simple. Factors that affect components of aggregate demand. Now listen to this carefully. Factors factors affecting aggregate demand. So factors that affect components of aggregate demand are obviously the factors that affect aggregate demand. Factors affecting aggregate demand, right? Is making sense? Okay, now I'll give you a couple of I'll give you some examples, and you have to tell me that what will happen in each case. Would aggregate demand increase or would aggregate demand decrease, right? So that's what we're about to do next. If prices of raw materials will be lower, the firm can be more competitive in the international markets as the production cost will be lower, causing more. Yeah. Prices, inflation. Okay, got it. Yeah. That's a very important point, which we completely skipped. Yeah, very good point. Yeah. So if local inflation rates are lower, right? Raw material prices. So you basically, yeah, if local um, local raw material is cheaper, local labor is cheaper, all of these things contribute towards your cost of production. So if your cost of production is lower, then obviously your products overall, their prices will be lower, relatively more competitive products, and therefore there will be more demand for your exports. Very good, excellent, that's correct. And vice versa, when your local inflation rates are higher, then your products will be expensive, and therefore people would want to import rather than buy local goods. So your imports will be higher when your local products are more expensive. Right, absolutely, very good. Okay, now students, have a look at this. Any confusion so far? Any confusion so far? Anything you did not get? You did not get anything you want me to explain again? If you're good, then we will look at this, right? Okay, now what do we have on the y-axis? Again, first of all, we'll just draw the normal general price level. So we'll draw the general price level on the y-axis, and you will have aggregate demand on the x-axis, right? Okay. Okay, now we will make a normal down sloping aggregate demand curve, right? Like this. Okay. Now, let me give you some hypothetical examples, and you need to tell me what will happen to aggregate demand in each case. Let's assume that, okay, so let's assume that interest rates of the country are decreasing. If interest rates of your country are decreasing, how will your aggregate demand change or shift or whatever? Right. It will, the aggregate demand will shift to the right. Very good, right? So students, think about this. Just like a normal demand curve shifts for factors apart from price, similarly, the aggregate demand will also shift either to the right or to the left, depending upon if any factor apart from general price level changes. I repeat. So if any factor, if any factor apart from general price level is changing, because when general price level will change, it will not be a shift. It will just be movement along the curve from point A to point B, right? But on the other hand, when any factor all the factors, in fact, that we just discussed. If there's change in any of these factors, your entire aggregate demand curve will shift either to the right or to the left, either to the right or to the left, right? Now, in this case, when interest rates are decreasing, more consumption because borrowing is cheaper, more investment because borrowing is cheaper. So your aggregate demand will increase, which means that at every price level, the demand will now be higher. That is what it shows, yes or no? So at this price level, JPL1, let's say previously on the pink graph, you had this much aggregate demand, right? So let's say 500 million or 500, whatever you want to call it, right? Just to get a specific value. And right, at the same general price level, on the higher aggregate demand curve, it's something higher, 600 million, and so on. Yes or no, right? Okay. Now moving forward, another example. What if um, what if country's population is increasing? What if country's population is increasing? How will you show it on this graph then? How will then the aggregate demand curve be affected, right? Again, shift to the right. Why? Because consumption will increase, right? The idea is simple: more population, more consumption, more aggregate demand. Yes or no? Easy. We good on this? Okay. What else? Similarly, we have talked about exchange rates. We have talked about other factors, inflation, right? So one way to look at this is if right. Okay. So okay. Now coming back to the idea of extension and contraction in aggregate demand, right? Now these were non-price factors. Now let's talk about the price factor and how is that affecting aggregate demand. Technology will improve this. Okay, now that's a good question. Okay, Zohan is saying, students, pay attention. So let me answer this first and then move forward. Zohan is saying that technology will improve this, also cause the aggregate uh, demand to shift to the right. So Zohan, think about this. Technology will affect your aggregate supply. Now just try to recall what we discussed when we were talking about normal demand and normal supply. Now think about this. I'm sitting at my home. Let me give you a very simple example. I'm sitting at my home and I feel like consuming more coffee, or I feel like consuming more, buying more clothes, or buying new car, or buying new laptop, right? Whatever, right? So my decision to buy something is regardless. I don't even know how laptops are made. I don't even know what machines are being used to make clothes now, right? And so on and so forth. So my decision to consume something is just based on my demand for it. However, technology does cause unemployment. Technology does cause unemployment. So with technology, with better technology, the ability to produce has improved. Businesses' ability to produce has improved. It can cut their cost, it can reduce their wastage. And when that happens, the profit levels improve, and therefore technology will affect aggregate supply. It does affect aggregate supply. So once after this, when we come to the aggregate supply, you'll see we'll talk about technology, right? Okay, now general price level. Think about this, students. So if previously this was the general price level, which means on average, goods are more expensive. Goods are more expensive in this country. Now, why would that mean lower? Why would that mean lower aggregate demand? So if this is your GPL, right, general price level, and this much is your AD, right, aggregate demand. Okay, the idea is that when you excuse me, when your prices are higher, right, how do people respond? Let's talk about each one of these components, right? So most probably with higher prices, consumers will consume less and save more. Why will they consume less? They are afraid that in future prices might rise even more. So they'll try to keep their consumption a little lower. Is it making sense? Right? Okay, so consumption would be lower. With investment, I mean, technically investment should be higher with higher general price level, because I mean, if prices are higher, this means that producers will sell their products at a higher price, which means more profit for them and all that. So this component might be increasing, right? this component might be higher investment component due to general price level, right? Then government spending usually doesn't much care about prices, right? If they have to spend on something, if they have to invest in a project, they will invest, right? But what about exports? Exports would be definitely lower. With higher general price level, your exports would be lower. Is it making sense? Why? Because we just discussed that higher prices of your products means that these products are less competitive on international markets, and therefore foreign consumers are likely to buy less, right? So your exports would be less and your imports would be higher. Why? Because your products are more expensive, so people want to buy foreign goods rather than to buy local goods. So three of these components, 3 out of 5 components of aggregate demand, as discussed, will decrease or will be lower if your general price level is higher, and vice versa. When your general price level drops down to a lower level, right, then your consumption will increase because people are more optimistic about the future. Secondly, they have this opportunity to buy more when prices are lower, so they will want to take benefit of this opportunity. Yes or no, right? So is it making sense? Right? So consumption will increase. So everything will go opposite. So when general price level is decreasing, things will go in the opposite direction. How? So let me tell you, your consumption will be higher. Your consumption would be higher since prices are lower. So consumers, want to consume more. Consumption would be higher. Your investment might be lower. I mean, that's one thing. Government spending is not much affected due to inflation. Exports will be higher and your imports would be lower, right? So this is basically extension in aggregate demand, just like we used to discuss, extension in demand. Students, is it making sense, right? So this means inverse relationship between general price level and aggregate demand. Higher the general price level, lower the aggregate demand, lower the general price level, higher the aggregate demand. Got it? Okay, perfect. Now coming to, okay, now we have two options, students. We can stop here for today and tomorrow. I think let's stop here for today and tomorrow we can have a longer session in which we will discuss the factors that affect aggregate supply. We'll do that quickly. Then we'll talk about the shapes of aggregate supply, right? There's short run aggregate supply and then there's long run aggregate supply, right? So I'll see you tomorrow then at the same time. And then tomorrow if we need, we can have a little longer session, right? Okay, take care, have a good night, and I'll see you tomorrow. Allah Hafiz.